If you own shares of a stock that has pulled back hard, but you're not ready to sell, and you're wondering how to generate income without getting whipsawed, this one's for you. In this video, I'm answering a real question from a trader who holds 200 shares of NVDA with a cost basis of $127. With the stock now trading around $110, he's sitting on an unrealized loss, but wants to start bringing in options premium carefully. I'm Patricia Saylor, Managing Partner of Saylor Financial Fundamentals. In this video, I walk you through two approaches. The first is a conservative strategy, selling a single covered call at the $127 strike just a few weeks out. It's low risk, gives the stock room to recover, and brings in some premium while we wait. The second is a more active repair strategy, selling 100 shares now, then using the capital to open a cash-secured put below the original cost basis, along with a covered call above it. If assigned, you're back to 200 shares with an improved average cost and a whole lot more premium in your pocket. Both trades are in the log, and we're doing them in real time with eyes wide open. I'll walk you through what I choose, why I chose it, and the possible outcomes by the June expiration. Let's get into it. Our trader owns 200 shares of NVDA with an investment of $25,400. The shares are currently worth $110.98 apiece. The net liquidating value of the entire position is $22,196, meaning he has a $3,204 unrealized loss. The goal is to help him exit this position without locking in a loss. I would suggest he start by selling a single covered call with a strike price of $127 expiring on April 25th. The premiums are not great, but let's see how much he could bring in. The April 11th call, which is 9 days to expiration, would generate about $12 in premium. If he went out to April 17th, he could bring in about $31, and by going out to April 25th, he could bring in $59. $59, $58 is a non-trivial amount, and if the share price begins to recover, he could probably sell another one with a strike price of maybe $130 and generate even more premium. So the easiest, most conservative way to trade this would be to start with a single covered call with a strike price of $127, watch for the share price to recover, then sell another covered call at $127 or above, maybe even $130 or $140 to bring in more premium and to potentially lock in some capital gains when he has to sell the shares. If he brings in $59 of premium, that's a 7.37% return on these 100 shares. This is not a great trade, but it does bring in a little bit of premium, creates some time for the share price to recover, and avoids the risk of whipsaw he would be taking on if he sold with a lower strike price. But if this were my position, I would take a different approach. I would go all the way out to June 20th, which is 79 days to expiration, sell 100 shares, and then sell a cash-secured put that brings in enough premium to make up for the loss on the value of the shares. And then I would sell a covered call with a higher strike price. Let me show you what this one would look like, because this is kind of a complicated trade, but I think it sets up a potentially better outcome in the long run. If I sell these shares for $110.50, I will be locking in a loss of $16.50 a share. So I want to make sure that the cash secured put that I sell brings in more than $16.50. I see here a $123 put and a $124 put that both would work. I'm going to use the $124 put. Selling 100 shares and selling a June 20th put with a strike price of $124 would bring in $127.99. So that's about $100 more than the price that I just paid for these shares. It filled at $128.11. Now I'm going to sell a covered call with a strike price of $130. That will bring me $350 right now, and if it goes in the money and the shares are called away, I will also bring in another $300 in capital gains. So let's see where things stand after this series of trades. I was assigned to buy 200 shares, sold 100 of them at a loss, made up for that loss by selling a cash secured put that is in the money but with a strike price lower than the price I paid for the shares. And then I sold a covered call with a strike price $3 above my cost basis. Let me change this number here. I was going to sell one at 128, but I decided to go for a slightly higher strike price. At this point, my out-of-pocket cost is $12,235.32, and I have 100 shares in the account. So rather than an average investment per share of $127, I have an average cost basis of $122.35. If the share price stays below $124, this cash secured put is still at risk of assignment. But even if I'm assigned to buy these shares back at $124, I have brought in a considerable amount of options premium, and I would be buying them back for $3 a share less than I just paid for them. These moves do improve the position, reduce the cost basis, and create some time for the share price to recover. If I did nothing and let this play out, if the share price at expiration were, for example, 120, or if it were 135, these would be the outcomes. If I am assigned to buy 100 more shares of NVDA, I will have bought 200 shares, sold 100 shares, sold a cash secured put, sold a covered call, and then be assigned to buy 100 more shares. My out-of-pocket cost at that point will be $24,635.32, and I will have 200 shares. That outcome brings my cost basis down to $123.17 a share. And if the price of NVIDIA goes above $130 a share, I will have been assigned 200 shares, sold 100 shares, sold a cash secured put, and sold a covered call. The cash secured put will expire worthless, and I will be assigned to sell the shares at $130, and I will have a profit of $764.68. There are lots of combinations of strike prices and expiration dates and premiums that will improve this position. There is no one right way to repair it, but there are multiple ways to chip away at this loss and generate some premium and reduce the cost basis, whether the share price recovers or not.